You need to hear this if you're a new investor. Thanks for joining me today. If you're diving into the world of finance, understanding your options is crucial. With so many choices available, it can be overwhelming to decide where to start or what to invest in. So let's break down the differences between mutual funds, ETFs, stocks, bonds, and indexes. Each of these financial instruments has its own unique characteristics, benefits, and risks. First, let's talk stocks and bonds. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company. When you buy a stock, you're buying a piece of that company and hoping it does well, so the value of your stock increases. The potential for high returns is one of the main attractions of investing in stocks. Dividends might be a bonus if the company shares profits with shareholders. Not all companies pay dividends, but those that do provide an additional income stream. Bonds, however, are a form of debt. When you buy a bond, you're lending money to a government or corporation. When you buy a bond, you're lending money to a government or corporation in exchange for periodic interest payments and the return of the bond's face value when it matures. This makes bonds a more predictable investment. Bonds are generally considered safer than stocks but typically offer lower returns. They are often used to balance the risk in an investment portfolio. Now, indexes. An index is a statistical measure of the performance of a group of assets. It provides a snapshot of how a particular segment of the market is performing. For example, the S&P 500 tracks the performance of 500 large U.S. companies. It's one of the most commonly followed equity indices. Investors use indexes to gauge market performance and often invest in index funds or ETFs that aim to replicate the performance of these indexes. This allows for broad market exposure with lower costs. Next, mutual funds and ETFs. Both are collections of stocks, bonds, or other securities, but how you buy them is different. Mutual funds and ETFs allow you to invest in a diversified portfolio without having to pick individual stocks or bonds. Mutual funds are bought directly from the fund company at the end of the trading day. This means you get the net asset value, NAV, price calculated at the end of the day. They often come with higher fees due to active management. Fund managers actively select and manage the investments in the fund, aiming to outperform the market. On the other hand, ETFs or exchange-traded funds trade like stocks throughout the day on an exchange. This allows for more flexibility in buying and selling. They usually have lower fees because most are passively managed. ETFs often track an index, meaning they aim to replicate the performance of a specific market index. So why does this matter? Understanding these financial instruments helps you make more informed decisions about where to put your money. Each option has its own set of advantages and disadvantages depending on your financial goals and risk tolerance. Mutual funds and ETFs offer diversification, stocks offer ownership and potential high returns, bonds offer stability, and indexes provide a snapshot of market performance. By understanding these differences, you can create a balanced and diversified investment portfolio. I hope you found this breakdown helpful. If you did, make sure to hit that like button and subscribe for more finance tips and explanations. Your support helps us create more content to help you navigate the world of finance. Thanks for watching and see you next time.